Jay Coulter here at the Morningstar Investment Conference. I'm speaking with Ben Johnson, the director of ETF Global Research. You just did a big session. What'd you guys talk about? Who'd you have on stage?
Yeah, so Jay, I got to spend some time with AQR's Cliff Asness, which is always a treat. Cliff has a lot of opinions about a lot of different things, and one of the first questions I posed to Cliff was about something he said time and time again about investment strategies, specifically that the best investment strategies are the ones that investors and advisors are most likely to stick with through thick and through thin, because that's ultimately what matters most. And what we've seen in recent years is that not just AQR strategies, but a variety of different strategies and value strategies in particular, is that they've been really tough to stick with. It's been like that scene in Dune where you put your hand in the Gom Jabbar and all you feel is pain, but if you move, you're going to die. Well, people have been crying uncle, taking their hand out of the Gom Jabbar and fleeing strategies in many cases at precisely the wrong time, because what we've seen in recent months is that value strategies in particular have had a bit of a comeback. They've snapped back after a long, dark winter. And what matters more so than anything with a value strategy, a momentum strategy, growth funds, a great active manager, is that you're there with your ticket in hand when the train shows up. You're going to get paid, when you're going to get on board. And I think that's a huge piece of the value that advisors can deliver to their clients, is to hold their hand and to get them to sit tight, because they can be your best ally and prevent you from being your own worst enemy as an investor.
Ben, I've been in this industry since the 90s, and what you just described happens time and time and time again. So Cliff's obviously right about that, just from a practical application. What else did you learn from his talk? Because I know it's hard to get opinions out of him. Did you find any?
There were quite a few. I think one of the other areas I was interested to talk to him about, because he's written about it extensively, is ESG. ESG is everywhere right now. There are so many different opinions. There's so many different data sets. There's so much information. It's always shifting. Frankly, it's difficult to understand what really is going on. And I think Cliff has just a great way of grounding it in just the basic precepts of empirical finance, which dictate that if people are going to want less of something, that something is going to have to offer better returns to people who will actually buy it in order to incent them to buy it. Mm-hmm. So as ESG integration goes ever further into the investment ecosystem, what you're going to see is a whole host of quote unquote bad companies that in all likelihood are going to see fewer and fewer prospective investors. Their investor base will shrink. They're going to have to offer better returns to those investors. So you can't have your cake and eat it too as an ESG investor necessarily. You might be getting lesser returns, but at the same time, by virtue of raising those companies' costs of capital as you run away from them, you're increasing the hurdle rate for them to invest their own capital, and they're going to rethink what they're doing. Maybe they're going to start polluting less. Maybe they're going to redirect capital to those projects that are going to make the world a better place for us all. So I think Cliff has a great ability to kind of take out all the hype, take out all the fluff, and really ground it in the fundamentals in a way that makes sense and links back directly to, again, the fundamentals of investing.
He also recorded a podcast with the Longview folks earlier today. Great episode. If you're not connected to the Longview podcast, please subscribe. Ben, I'd be remiss if I didn't ask you some other questions outside of the scope of that session here today.
Sure.
Our audience are financial advisors, and the first one's going to be a softball.
Mm-hmm.
What are advisors missing today when it comes to their portfolio construction?
If there's anything I think that advisors and just investors in general are missing, is that time and time again, simple beats complex. This applies not just to portfolio construction. Like, think of your washer dryer. Do I really need a washer dryer that only uses a teaspoon of water and deploys shards of silver into my gym socks, like to make those as fresh and clean as possible? Or is that thing just going to break time and time again, and I'm going to be spending $450 to have a service call and a new panel installed? Like, I, for my part, have a good old-fashioned Speed Queen washer and dryer that is a barrel with an engine attached to it with a belt that spins, gets stuff wet, and then dries it off. it applies to everything. Coffee makers, like pour over coffee. Does it get simpler than that? I use these examples because it applies to investing as well. Simple almost always beats complex. So don't overthink it. Don't make it any harder than it needs to be, because what investors need more so than anything is just market exposure. They need to get exposure to markets. They need to sit tight. They need to have that exposure for as long as possible, avoid being their own worst enemy. And if they can do that, it's really pretty darn easy. And you can do it today at as low a cost as ever, in a way that is more tax efficient than ever. So investors should be celebrating simplicity.
Yeah. So we definitely agree with simplicity. We've been talking about this for a long time. Complexity has killed a lot of investment portfolios over time. But can they be too simple? Is passive indexing creating issues for financial advisors and, more importantly, their clients? I know you're pretty outspoken on this. What's your take on the risks of passive indexing?
So, indexing, despite the fact now that, Vanguard launched the first ever index mutual fund now decades ago, is really kind of still the new kid on the block in many ways. And not only is it the new kid on the block, but it's a pretty menacing kid for a lot of industry incumbents who are used to doing things a very certain way and getting paid a very certain amount for doing things that way. Now I can go out and buy a total stock market index fund to get that market exposure for nothing if I so choose. If I really am, feeling like spending a lot of money, maybe I paid 3 bips for that portfolio. Like, that is maybe the best thing that has ever happened to investors. So naturally, I think a lot of incumbents in the market are going to say, well, this is bad. And it's been happening, to be clear, now for every decade and every year since the first index fund was launched, where incumbents worried about the impact on markets. They've been called un-American, worse than Marxism. Index ETFs have been called weapons of mass destruction, because these people are worried about their own livelihoods, because indexing is a threat to their own livelihoods. I would stress too that many of these same concerns were raised about mutual funds in the 1960s, when mutual funds were first a thing. There were professional investors that fretted over the quote unquote mutual fund situation, and a scenario where all these new retail investors that were enjoying like the broadest, lowest cost diversification that had at that point ever been made available to them, that they were going to flee the markets as soon as the markets took a turn for the worse and make everything terrible for everyone involved. So, this is a tale as old as time. If indexing gets to the point where it is grown to the extent that it in some way distorts markets, makes them less efficient, that is going to create opportunities for smart people to step in and profit. So I think investors should celebrate the fact that they can get broad market exposure, build a 3 or 4 fund portfolio, and pay next to nothing for it. And I think they should take confidence in the fact that if it goes too far, it's going to snap back. Markets have a tendency to heal themselves, no different than, a forest that gets struck by lightning and burns down will regrow over the course of 20 or 30 or 40 years. So I'm personally not worried about it. And I think, these concerns, these insults, whatever you want to call them, are going to continue to be flung in the direction of indexing for as long as I'm alive.
Yep. All right. So thematic investing has been very popular in our network for a while now. You had a tweet out here recently talking about how there's been a 79% drawdown in the thematic space. Was it a drawdown?
So we've seen trailing 12-month flows into thematic funds globally. So this is a global phenomenon. They've dropped 3/4 from their level just a year ago, so down 75%. And it is not a coincidence that has coincided with a sharp turn for the worse in many of these funds' performance. And I think the poster child for this has been ARKK, Kathy Wood and ARK Invest's flagship ETF. What we've seen is that a lot of the enthusiasm among these unprofitable, high growth names has not just faded, it's been just completely rugged. And ARK is an example, down more than I think 50% year to date last I checked. So, what we see here is, again, not anything new. It's a pattern of performance chasing behavior that in this most recent cycle has really been on steroids. And part of that may be attributable to the fact that people were stuck at home, were getting government stimulus checks that they didn't know what to do with, and started day trading from their mom's basement. Part of that is that there is always an interesting and compelling narrative behind these concepts, behind these funds. Kathy can spin that narrative as well as just about anyone. But if you go back in time, we're actually sitting right now, I should tell you, in the home of what was one of the first ever thematic funds, which was the Television Fund, which was a fund that was launched in 1948, a time when there were fewer than 1 million televisions in the United States. Color TV wasn't even a thing yet. So what you're going to see in thematic funds is just narratives being packaged, and what you're betting on is really, I use the analogy from the horse track, it's a trifecta. So you invest in a thematic fund, you're betting that you're getting the theme right, so that this is a real thing, that it's durable. So another thematic fund from the thematic funds graveyard is the Stedman Oceanographic Fund. So this was a way to invest in a future where everybody was living underneath the ocean in some sort of sub-aquatic Jetsons-like ecosystem. Okay, so that clearly was not a durable theme, I can say, because we're here above ground in the city of Chicago and not under Lake Michigan. You are also betting that not just the theme is durable, but the fund owns the right stocks. So you look at right now, we've got a pair of vegan ETFs as an example in the US market. One of those vegan ETFs has a portfolio that matches that theme every bit as well as Paisley matches Plaid. The other one truly invests in firms, public corporations, that could benefit from the growth of a larger segment of the population adopting a vegan diet of one degree or another. So you've got to get the theme right, you've got to get the stocks right, and most importantly, you've got to get the valuations right. And by the time that there's not one, but two, but three, I think we're now like at least over 24 different blockchain ETFs as an example. Once those make it to market, odds are that investors' enthusiasm for that theme has been more than priced in. So you're probably familiar with the old adage, buy the rumor, sell the news. If anything, I would argue many examples we've seen would add a leg to that, which is buy the rumors, sell the news, maybe short sell the thematic ETF. And a recent example of that was actually an NFT themed ETF that launched in December of 2021 and has lost more than 50% of its value in the ensuing months.
So when I prep for these interviews, I generally have follow-up questions in mind. I'm a little concerned about my follow-up question, but I'm going to ask it anyway. So for an advisor who still thinks there's a place for thematic investing, instead of asking you, is there a place? For the advisor who does think there is, how could you implement thematics into a portfolio?
Well, I think it's going through that checklist, right, that I just described with the trifecta bet. Like, is this truly a durable theme? And some themes are more durable than others. You go back to the dot-com boom when we saw the last major wave of thematic funds come to market, and there were 50 different internet-themed funds that were launched. There's just 5 of those that are still alive today, and some of them actually have performed quite well. Like the internet, it turned out to be a thing. The problem is that we just got a little too excited about what the internet was going to do for us a little bit too soon. So the durability of the theme, getting the portfolio right. And not all of these are index portfolios. Some are indexed, some are active. There are a lot of discretionary active managers out there that have been doing some version of what we can call thematic investing, which is really probably more aptly described as like emergent growth investing, and doing it really well for a long period of time. So maybe if you're interested in, kind of high octane growth, like visions of the future, seek out some of those managers to partner with. And valuations are valuations, right? So I think clearly with the benefit of hindsight, we can look back and say, wow, it probably didn't make sense to pay a multiple of 350. I don't know what metric, because there's no earnings, no cash flows, no book value, but 350 times something for some of these stocks. Just always have your head on straight. And I think, be able to like talk your clients down sometimes, so that they're not sort of attracted by the siren song of what are always really cool narratives. Like, I'm not anti-innovation. Like, I think the world's going to be a better place. Like, we'll get flying cars one day, maybe. But, that doesn't necessarily mean that I'm going to put all of my 401k into one of these funds.
Yeah, that can be said of any investment. Absolutely. If you're a prudent investment advisor. I told you this would be 5 minutes. We've clearly gone a lot longer. I'd love to ask you one more question, though. Please. The biggest question I get from the advisor community is generally centered around fixed income the last 4 or 5 months and what to do in a portfolio. At a very high level, how should advisors look at fixed income, specifically around indexing in today's environment?
Yeah, I mean, I think it's like important to remember that stocks are not bonds, and you own bonds because they're not stocks, because it's a very different instrument. It's a very different set of cash flows. There's much more certainty there. You get, in most cases, not a guarantee, but a near guarantee, especially with higher quality credit or government bonds of a return of principal. And over a long enough period of time, it makes sense to spread your bets, right? Across both stocks and bonds. When it comes to indexing, I think the most important thing to understand is that the composition of any given bond index is really going to reflect that segment of the market, be it the government, be it corporates, ability to, or desire and ability to ask people for money. And what that means is that the composition of these bond benchmarks is going to evolve over time. We've seen it with the ag, for example, over the years, where you see, a constant push and pull in terms of its allocations between government bonds and corporate debt. You've seen its duration sort of ebb and flow depending on how far out they can place those bonds. So it's important to understand, in the case of not just bond indexes, but indexes in general, is that indexes are living, breathing things. They're meant to reflect the market. They're not trying to do any better or worse. They're just trying to represent it. So when you sign up for that, you're going to get the market return, less a reasonable fee. If this sounds an awful lot like I'm channeling Jack Bogle, it's because I am. And more investors over time have said, that's perfectly fine for me, because it means there's going to be no alarms and no surprises. And that is going to help me sleep at night.
Excellent. I appreciate your time here today going through this. If you're on Twitter, make sure you follow Ben. They say that to build a impactful audience, you have to inspire, entertain, or educate. And Ben does all three of those on Twitter if you're interested in the capital markets. Thanks a lot for coming on.
Thanks, Jake.